Let's talk a little bit about trending topics, and for this episode, we're going to mix it up a little bit. Really happy to say that we have Scott Gingles, President and CEO of Nest Mortgages, joining us. Our marketplace has been on a torrid pace over the last 6 months. We know that mortgages are playing a really important role in the financing of real estate. Scott, we're so excited to have you on the show today. We want to learn a little bit about mortgages, what's happening with rates, and where everything is going.
Thank you for having me.
Why don't we just jump into it?
Sure.
I'll kick us off. We know that price point is running away. Greater Vancouver up 2.9% in the last 2 months. It's up almost 13% over the past year. The Fraser Valley is up 3.9%, and detached homes are up 20% over the last year. How much impact are some of the record low rates that we're seeing today affecting price?
It's a huge driver. As you mentioned, historically low interest rates. This is something we've had access to for roughly the last year. Government did everything they could heading into the pandemic to backstop the economy, which impacted bond yields, and they dropped to levels that we'd never seen before. To source 5-year fixed rates or 5-year variable in the 1% to 2% range has been common, and it's absolutely been a driver of that activity in the market.
It's such an interesting moment in time right now, and we're seeing the relationship between variable and fixed, maybe to some of the smallest buffers that we would typically experience. And of course, we know the bond market is really shifting over the last 2 weeks. How much is that variability playing into how banks are trying to account for the risk of interest rates rising over the next 5 years?
Well, yeah, every metric the banks price their 5-year fixed have surged over the last couple of weeks. Swap rates, bond yields, and government yields. I think the impact has been about 25 basis point increase in 5-year fixed rates just over that short period, which is a dramatic change over the last year where we haven't seen any movement from those low levels. People are starting to inquire about fixed versus variable. Did you want to get into that? Yeah.
Whatever you think. Whatever you think's right.
Well, we can still access variable rates at roughly 1.5%, and 5-year fixed rates are climbing to closer to that 2% threshold. It's a question we face a lot of the time, whether to go variable or fixed. We would say if you're an established buyer, if you can tolerate some risk, variable is typically the way to go. The advantage to variable: it's the absolute lowest rate we can access today. It's the most flexible. The maximum penalty or breakage that we would ever face is 3 months interest penalty, and the ability to lock in anytime, no fee or any penalty.
So if that's true of the variable, why should someone be picking fixed?
Well, on the other side, with regards to fixed, it's about risk tolerance, I think. If you're certain that you're going to be in your home for the next 5 years and then you're not going to make any changes, fixed might be the way you want to go. Right now we can access a fixed rate at 1.79 on a high ratio purchase or insurable, and it's an incredibly strong fixed rate. The average life of a mortgage is 3.5 years in Canada. There's many reasons to possibly break your mortgage that we can talk about a little bit later. So if you know that you want to be in your mortgage for the next 5 years or longer and you want to set it and forget it, that's the type of strategy. 5-year fixed is the way to go.
So low risk, I want to sleep at night, I want to know exactly what my payment's going to be every time, no changes, I'm going fixed. So the rates that you just shared are obviously drastically different today and have been for the last 12 months than they were, say, 2 or 3 years ago. So for people who have a mortgage at a much higher rate, what's that tipping point? Should they be thinking about refinancing? What's that process like?
Yeah, heading into 2020, the rates were around 3%, 2.5% to 3%. And being able to access rates at even 1.5% today, 1% less. On a $500,000 mortgage, quick math is, you'll save up to $30,000 to $40,000 in interest over the remainder of the term. So in terms of refinancing, not only can you save on your mortgage alone, we've got many tools where we can crunch those numbers for you and make sure that the interest savings outweigh the breakage and that it's a true advantage. But other reasons to refinance are debt consolidation, investment. If you want to purchase a second home or a pre-sale, there's lots of reasons to access the equity in your home in the form of a refinance.
There's been so much conversation in the media lately around inflation, economic output as a result of vaccination, right? Borders opening up, air travel obviously beginning to resume, business activities then beginning to blossom from that. And out of that comes the belief that interest rates may be on the move over the coming years. We've been in this low rate environment for quite some time. We think that that has an impact on demand of real estate. What's your expectation over the next 3 years when it comes to rates?
Yeah, the only thing that's certain is that nothing is certain. The Bank of Canada chimed in this week, and they're holding steady to the fact that rates will remain low till 2023. They're continuing their quantitative easing, and everything is status quo. The street and bond traders and such have a more aggressive outlook. They think rates will rise in 2022. It's anyone's best guess right now. I guess the biggest threat is that possible variant and future closures. But there's a lot of positives in coming out of the economy, growth, some questions around unemployment. So again, anyone's best guess, but I honestly think we're in a low rate environment for some time to come. There's a lot of emotion in the market, and when there's a slight increase, it creates a feeling around mortgages and rates and real estate. But I think we're in a low rate environment for some time to come.
The Bank of Canada always talks about, people over leveraging or worrying about, obviously there's stricter guidelines around what you can qualify for, because we want people to ensure that if rates do go up, that people can still cover their mortgage. Given that rates are so low, is that something you think we need to be worrying about?
That's a great question. And something Ryan and I have talked about recently is there's qualification and then there's affordability. The rates are incredibly low, and it makes it quite affordable for everyone. I would argue that lending and underwriting practices in Canada have been strong for some time. Even through this heightened activity and heightened borrowing, arguably, we're still qualifying at the benchmark, which is almost 3% higher than what fixed and variable rates are today. So although there's a lot of activity and there's a lot of borrowing, we're qualifying at 4.79% today, either at 25-year AM or 30-year AM if you have considerably more equity or down payment. So I think the responsible lending practices are still in place, and to answer your question, I think we're in good shape in terms of affordability and borrowing.
So for the time being, low rate environments, the expectation is that there's no discussion, gossip, or potential threat of government, federal, or provincial impact on adjustments to mortgage lending and the qualification rate. And all of that feels then like we will continue to see the markets run as long as debt is relatively cheap and as long as demand is outstripping supply.
Yeah, heading into the spring of 2020, pre-pandemic, the government was focused on getting Canadians into homes and making it affordable. A lot of those mandates were put on pause, and obviously due to the pandemic, the recent charge in the market, some would argue would maybe put real estate out of reach for some, and I know the government has a close eye on that. Yeah, some would say that affordability is out of reach. I just hope that the government stands by and allows the market to take its course. Government intervention typically not a good thing because it's reactionary, and I think there's good underwriting and lending practices in place, and let the market take its course.
I think like anything, you start pulling the levers. Where do you stop? Right? It becomes very challenging, and these have huge impacts. These swings truly impact equity in people's homes, and you have many that have paid down their mortgages for a lifetime, and it's very, very challenging to see a portion of that equity stripped away because of adjustment in tax policy or adjustment in criteria policy. And I think that's the threat that we all worry about. But for the time being, it does feel like there is no sentiment that the federal government is looking at that, and so from that perspective, it does feel like the market will continue to surge.
All right, on that note, Scott Gingles from Nest Mortgage Co., thank you so much for being here today. Really appreciate the insight. It was fun to have someone else sort of join us for our trending topic today. Not that it's not amazing, but it's just you and I, but a fresh voice is always fun. If people want to get in touch with you, they want to get pre-approved, or they want to ask you some of these questions, they're thinking about refinancing, all that good stuff, what's the best way to get in touch with you?
Yeah. Appreciate that, and reach out anytime. nestmortgage.co or info@nestmortgage.co, and we'll attach the link in the video.
Yes, that's a great idea. We will do that. So that's a wrap for today. Thank you so much for joining us. Again, like, subscribe, and or email us, and we will see you next time.